Sure. Mr. Macklem, in your most recent monetary policy report, I'm going to quote a section there. It says, weak growth is likely in the second half of 2025. After contracting in the second quarter, GDP growth is estimated to be about 0.75% on average for the second half of the year. So when we look at it on a year-to-date basis, is it fair to say that performance is basically neutral for our economy? But of course, the Prime Minister is promising Canadians that he's going to be building the economy at unimaginable speeds not seen since the Second World War. So I did a bit of research, and it looks like Canada's GDP growth following the years of the Second World War were between 6 and 7%. So based on your forecasts, when do you expect that we would achieve that 67% GDP growth?
Our forecast goes out about 2 to 3 years, and we don't achieve that. We've got, I think, 1.2, 1.1, and 1.6 in 2027.
And what do you think the economy would need to achieve that 6 and 7% GDP growth?
Well, if we want much higher, growth in the economy, we're going to need much higher productivity growth.
Okay. So when I read the news, I see that auto manufacturers have relocated investment to the U.S., some big names recently. Housing starts in Toronto specifically are at 30-year low. Bottling companies are also moving operations to the U.S. And of course, small businesses have been heavily impacted because of the U.S. tariffs. Given that, do you believe that our economy is growing at unimaginable speeds, like the Prime Minister has mentioned?
At a what speed?
Unimaginable.
Unimaginable. Well, I'm not really going to put it on. I mean,
decades.
you can decide on the adjective. I mean, our forecast is 1.1, 1.2, 1.6.
So, in simple terms, for Canadians watching, that means that our economy is not growing very fast.
No.
Is that fair to say?
No, our economy is not growing very fast. It's been hit with a major structural shock. As you indicated, growth in the second quarter was negative. Economy contracted 1.6%. That was largely as a result of a big drop in exports to the United States. We think growth in the second half of the year, which, we're in November now, so a lot of that's already happened, but we don't have all the data yet. We think it's going to be pretty modest, 0.5 for Q3, 1% for Q4. And that's really because, to get back to Mr. Garon's question, consumption growth's holding up. That's supporting growth, but exports and business investment remain weak. As you get into next year, we think there'll be some recovery in exports and business investment, so growth picks up. But yes, I mean, even 2027, 1.6% growth is not particularly strong.
And so you did touch on my next question a little bit. So your report mentions that GDP downgrade reflects lost capacity in a productivity crisis, of course, not a surge of growth. When I think of lost productivity, that's not something that is easily restored, of course, because oftentimes when I think of a business that's heavily or capital intensive, once they've moved operations to another country, very unlikely that they will actually return, predominantly in manufacturing. So how does the lost capacity and productivity crisis impact the overall growth of the economy?
Well, really, my point in highlighting that this isn't a typical cyclical, it's not a typical business cycle, it's a structural adjustment. Part of the message there is that it's going to take longer than normal because rather than sort of demand coming back and businesses have had unused capacity, they now put that, they bring workers back to work, they increase production, and everything bounces back. This, in a structural adjustment, sectors need to pivot. They need to invest in new things. They're going to be doing less of some things. They need to be doing more of other things. And that is going to take time. So that's an important reason why the pickup in the economy is relatively gradual.
Thank you.
Over to you.
Ms. Kobina.
Okay, well, I'd better get started. Thank you, Chair, and we're very pleased to be back at this committee to discuss our recent policy decision as well as our outlook for the Canadian economy that we published in the Monetary Policy Report last week. So last week we lowered the policy interest rate 25 basis points, bringing it to 2.25%. This was our second straight cut and reflects ongoing weakness in the Canadian economy and contained inflationary pressures. We also published our outlook for the Canadian economy, and in this context we have four main messages. First, U.S. tariffs and trade uncertainty have weakened the Canadian economy. We expect very modest growth through the rest of this year with some pickup next year. Second, while this weakness is restraining price increases, the trade conflict is also adding costs, and that is putting some upward pressure on inflation. We expect those opposing forces to roughly offset, keeping inflation close to our 2% target. Third, to support the economy through this period of adjustment, we have lowered our policy interest rate by 100 basis points since the start of the year. And finally, the weakness we're seeing in the Canadian economy is more than a cyclical downturn. It's also a structural transition. U.S. trade restrictions have diminished Canada's economic prospects. The structural damage caused by tariffs is reducing our productive capacity and adding costs. This limits the ability of monetary policy to boost demand while maintaining low inflation. So let me turn now to economic conditions. While U.S. trade policy remains unpredictable, its impacts are becoming clear. Le PIB du Canada s'est contracté de 1,6%.
Canada's GDP contracted 1.6% in the second quarter as tariffs and uncertainty reduced exports and business investment. U.S. trade actions are having severe effects on targeted sectors, including auto, steel, aluminum, and lumber. Household spending has been resilient in the second quarter, with strong consumer spending and a pickup in residential investment. The labour market is soft. Employment gains in September followed 2 months of sizable losses. Job losses have been concentrated in trade-sensitive sectors, and hiring has been weak across the economy. The unemployment rate remained at 7.1% in September, and wage growth has slowed down. In the second half of this year, GDP growth is expected to pick up, but shall remain weak, averaging about 0.75%. It should then pick up on a quarterly basis in 2026 as exports and investment recover, and should average about 1.5% by 2027. This implies that excess supply is only taken up gradually. CPI inflation came in at 2.4% in September, slightly higher than the bank had anticipated. The bank's preferred measures of core inflation have been sticky around 3%, but upward momentum has dissipated. Looking at a broader range of indicators, underlying inflation looks to be around 2.5%. The bank expects inflationary pressures to ease in the months ahead, and CPI inflation should remain near 2% over the projection horizon.
Roughly in line with our outlook, the Governing Council sees the current policy rate at about the right level to keep inflation close to 2% while helping the economy through this period of structural adjustment. We will be assessing incoming data carefully relative to the bank's outlook, and if the outlook changes, we are prepared to respond. For many months, we have been stressing that monetary policy cannot undo the damage caused by tariffs. Trade friction means our economy will work less efficiently with higher costs and less income. Even as economic growth recovers, the entire path for GDP is lower than it was before the swerve in U.S. trade policy. Monetary policy can help the economy adjust as long as inflation is well controlled, but it cannot restore the economy to its pre-tariff path. But I will add, there are things the country can do to get on a higher path. We don't need to accept a lower standard of living. Our focus at the Bank of Canada is ensuring Canadians can continue to have confidence in price stability through this period of global upheaval. And with that, I'd be very pleased to take your questions.
Great. Thank you so much, Mr. Macklem.